Are stocks finally turning a corner or it's just another fake out? Bond yields are on the move, the dollar is rising again, and the big tech just dropped earnings. In today's video, I'm breaking it all down simply and sharing my latest moves in the market. Plus, why being ready for volatility is the biggest edge you can have right now. Let's dive in. Hey everyone, welcome back to Streetwise Economics channel. I am Isaac Jonas, and today we are diving into what's happening across the stock market, bonds, and the currency market. Quick disclaimer, this video is for educational purposes only. I am sharing what I am doing and what I am seeing, not telling you what you should necessarily do. Trading and investing involve risk, so always do your own research or talk to a licensed financial advisor. Let's start with the stock market update. I'm recording this video on Friday, and it's 25th April 2025. And this week, mostly stocks in the tech space, they have been on the green. In other words, they have been going up. And if I look at the numbers of the major stocks that I follow, that include Meta, it was up 2.15%. Google was up 2.45% at the time of recording. I'm going to put it on the screen so that you can actually see. Tesla has a big standout today, and it was up 7.04%. As you know, stocks go up and down, but the interesting thing about the Tesla story is that they reported earnings, and I'm going to share a bit more about what I think about that. But not everything was green, of course. Apple, when I took the screenshot here, it had slipped to 0.49%. Again, these are fluctuations that can happen any minute, any second. But what I look at as an investor, I want to look at the long-term trend, not just price on a second-by-second basis as I do when I'm trading. Now, when I look at the broader S&P 500, it was slightly down about 0.29%. But as I look even now on the Bloomberg TV right there, it shows that the S&P 500 is already now up. So that's what happens. If you are a trader, this volatility can be something of interest, because if you bet your trades right, you can make a lot of money. Similarly, if your trades go in the other direction against you, then you are more likely going to lose a lot of money. So a summary of this is that the tech stocks, they are pulling ahead, but overall, the market is still very cautious. The key takeaway is that tech is driven by a lot of things such as earnings, but also what is happening in terms of the geopolitical landscape, especially the tariffs. But the broader market strength is not yet guaranteed. Now, to talk about the major earning highlights for Google and Tesla, Google surprised analysts with a very strong performance in ads and AI-driven cloud revenue. Google earnings for Q4 2024 were reported yesterday, and revenue grew by 12%, which was very interesting, and the stock actually went up even after market. However, Tesla had mixed results. Margins are getting squeezed, but Elon Musk teased the investors with a very bold future, and that's what he does. AI and robotics, these are keeping investors hopeful. But in terms of looking at the numbers, revenue, it dropped. If you are looking at sales, we all knew, those who follow the stock or the numbers, that the numbers were not going to be good. But I wasn't surprised. The stock actually went up. Even today, as I indicated, it is trading higher, because Elon Musk indicated that he was gonna be spending less time in the White House to actually come at the forefront and lead the business that he has been part of in a big way. So these indications are very important because they show that tech leaders are adapting, but the expectations are still high right now. And this is what is very important, because if the forward earnings, because if you are investing, in my case, I am looking at the potential return in the future. So if the story is different, the numbers, like for the case of Tesla, they are not in sync with what the leadership are promising, then for me, as a long-term investor, I don't want to be part of that. I want stocks that deliver in terms of the numbers, that have growing revenue, growing profit margins, and that still have strong fundamentals like lower debt, long-term debt, and things like good management, good products, increasing revenue, but also I like to see rising free cash flows. Once in a while, companies can do capital expenditure, but it has to be something that I can deem to generate a good return in the future. So moving on to the bond market. Now, bonds, I like to particularly look at the 10-year treasury yield, because right now it was sitting at 4.28%. And what does this mean? Investors are demanding higher returns for holding government debt in the US. So this reflects worries about the US needing to refinance its massive 9.2 trillion debt next year. Higher yields usually pressure stocks because they make the borrowing more expensive. So yields are a key risk to watch. I like to look at that indicator as well. Again, as I've said on this channel, the Fed sets overnight rates, and they can influence the monetary policy by money supply, and also they can kind of mop out liquidity, excess liquidity in the market using money supply, changing interest rates, increasing or reducing interest rates. Now, what that does is that can potentially move the market in a big way. But right now, President Trump and Chair Jerome Powell, there has been that kind of like, President Trump is saying Powell is slow to reduce rates. On the other hand, I understand that the Federal Open Market Committee, which is chaired by Jerome Powell, they make a collective decision, and he just speaks on behalf of the more like the board of directors. And their approach has been that they want to look at the data. If you look at inflation, 2.8%, if you look at the consumer sentiment, big companies such as Target, Walmart, they've been signaling that shops might actually be empty because of the tariffs, because some of these retailers, they import products from as far as China. So as long as that tariff issue is not resolved, there is going to be more likely supply chain bottlenecks, and that can affect consumers. I was also listening to a report that was shared on a memo by Phil Town. I like to follow him. He's a hedge fund manager, and he is one of the people like I like to follow as well, also what he's doing, how he's thinking. He indicated that the retail price, like, those big companies, they are signaling that, there is potentially a big risk. But again, if you are able to navigate through these storms, that's how you make a lot of money. Now, current market is something that I also have been paying attention to. The US dollar index just moved up to around 99.58, and of course it changes from minute to minute. But a stronger dollar can hurt multinational companies because their overseas profits can shrink, but it also shows that the global investors still trust the US economy more than others right now. It's another push-pull force investors should be aware of. In terms of the economic data recap, I like to look at the long-term trend, but of course it comes in drifts like this week, next week. But if I look at it, like I indicated, inflation is still running at 2.8%, and the growth indicators were slightly weaker than analysts expected. The bottom line is the economy is slowing, but not crashing yet. This is the US economy in particular. So that's why I always look at the macro data, in other words, the bigger picture. I like to look at the broader market picture before making trading or investing decisions. Moving on to my trades for the week. In my own trading, I added some new positions using cash secured puts. But let me also actually start by talking about my long-term portfolio. I added Mercado Libre and Booking today because they are down. And I'm just adding, dollar cost averaging, buying a few, let's say 500, $1,000 adding. But now I have a bit of cash because I sold my Google shares before the earnings pop. But the idea is that I wanted to have a bit of capital, and I'm considering continuing to do cash secured puts or covered calls, depending on the setups that I see. I like to have cash because at the end of the day, if you don't have cash, even if the market drops by 40, 50%, you are going to just say, and then people with money, they are going to be buying aggressively. And as the market recovers, if you are looking at the stock markets in particular, in this case, if it then bounce back, you make a lot of money, right? So remember, this is not advice, just sharing how I'm thinking through my risk and opportunities. I like options because they give me a way to manage volatility and create some cash flow. So that's why I do cash secured puts and also covered calls for the shares that I actually own. In terms of the lessons that I have learned this week, my biggest lesson has been that as a trader and investor, you have to be comfortable with volatility. In the current US and even Canadian market, volatility brings opportunity, but also quite elevated risks. So using trading strategies such as case secured puts and covered calls help me stay flexible, generate income, and protect my portfolio. So if you want to learn how to trade and invest wisely, manage the risk like a pro as well, book a coaching session with me at www.streetwiseeconomics.com. I would love you to help you to level up your trading game. So next week, I will also be sharing my full trading update on April 30. I've already recorded the video, but it will actually air on April 30th. And you won't want to miss this. I've been showing you how I have been trading and being profitable in this current market environment. So if you have found this video helpful, please like the video, subscribe to the channel, share what you are seeing or doing in the comments, and don't forget to check out my website, streetwiseeconomics.com, for weekly newsletter and full analysis. Thanks for watching, and until next time, trade and invest wisely, and may the markets be on your side. Thank you, and bye-bye.